Good afternoon, everyone. I wish to welcome you all to the Conceptual Fundamentals of Financial Accounting. So, first of all, I wish to introduce myself. I am Niruja Rajaglanayakam, attached to Department of Accounting, University of Jaffna as a lecturer. So here, I'm responsible to take these Conceptual Fundamentals of Financial Accounting to your batch. So, before moving to the first day lesson, I wish to introduce the course outline. Okay, so your chapter code is provided CST 307 and NT2, and the course name is Fundamentals of Financial Accounting. So it's for 2 credits. And so let's move to the course aim. So aim of this course is mainly to develop the capabilities to perform the basic accounting functions and the presentation of accounting statement for sole proprietorship. Okay, and under that we are going to cover these learning outcomes throughout our lectures. So let's see the assignment. So you are going to be evaluated by continuous assignment as well as the end of course assessment. There are 3 kinds of continuous assessment. There will be a quiz examination, and there is an assignment submission for 15 months, and there's a mid-semester for 10 months. And end of the examination carried 17% of the marks weight. So let's move to the first day session. So the first lesson of your course unit is Introduction to Principles of Accounting. So these are the learning objectives of today's session. So let's move on to the lesson. First, we will discuss what is accounting. So there are so many views. People normally confuse the job bookkeeping and accountancy together. But the accounting is a wider range of activities, so which can be defined as accounting is a system means of measuring business activities, processing of information into reports, and making the findings available to decision making. So here, measuring business activities in the sense the accounting going to be measured the business activities and its performance. So through the profit and loss statement of a business, the accounting provides the performance of each and every businesses. Likewise, throughout the analysis of information, the accounting is going to report about financial position of an organization. So here, it's make information as reports in the sense. Throughout the accounting process, it's going to analyze the report, accounting information and classify them and report the major information to the decision makers. So the decision makers in the sense who are using the accounting information for their economic decision. So we can say some example, the potential investors. So potential investors need to know about the performance of the organization or else the asset value of the organization in order to choose an organization where they wish to invest their money. So the second term, the accounting nowadays defined as a language of business. So the language in the sense, the way of communicating with others. So once we know something, we just use that one as a source of communicating with others. So as a business, it depends on the society at large. Okay, so now business cannot be operated without any connection with outsiders. There are outside investors, there are outside lenders, customers, suppliers. So there are so many outsiders related to the business activities. Therefore, those outsiders may have interested on the organization, what they are doing and how they make the profit and all. Therefore, business should communicate with the outsiders about their performance as well as position. Therefore, as a language, accounting helps to communicate with outsiders. That's why in the modern world, accounting is known as language of business that facilitates to communicate with outsiders. So the second one, the language of financial decision. So why we are saying accounting is a language of financial decision? The mainly the term financial in the sense accounting provides financial information more than the qualitative aspects. Therefore, if any people need to take economical decision, for example, investment decision, or else, for example, whether supply the goods to a particular organization or not, whether buy a good from an organization or not. So all these decisions are known as economic decision. So these information help to make the financial decision. Therefore, it also known as the language of financial decision. Let's move on to the next slide. So let's see how the term accounting is defined. So accounting is the process of identifying, measuring, recording, and communicating an organization economic activities to users. So the first one is identifying in the sense identifying a transaction. Okay, so if any financial run event occurs within the organization, so the organization first need to identify the transaction. Then they have to measure in the term of monetary values. Then the transaction should be recorded in the books of account. So once they recorded, then they have to prepare the final accounts. So that is the financial statements of a particular company. Finally, those prepared financial statements should be published in order to communicate with outsiders as well as insiders of the organization. So these published financial information help to take wider range of economic decision. So this definition provided by the American Accounting Association. So here, let's see this diagram. There's an event. So within the organization, there are so many events. However, some are related with finance events, some are non-financial event. And the second one, the accountants analyzes and recording. Once the event occurred, the accountant need to analyze them and record in the books of account. Then, based on the records, they have to prepare the finance statement and submit them to the users. So this is the normal cycle of the accounting system. So let's move to the users. So there are so many users prefer to use the accounting informations. So the users need information for their economic decision. So these users can be categorized as internal users as well as external users. So the internal users of accounting information work for the organization and are responsible for organization activities like planning, organizing, and operating the entity. The area of accounting known as the managerial accounting that serves the decision-making needs of internal users. So the people who are responsible to do the management accounting, they have to know so many information related with the organization in order to provide those information to the managers to take economic decisions. So the internal users are the managers, employees, even the board of directors within the company. And the external users, they do not work for the organization, but they are directly or indirectly related with the organization. It includes investors, creditors, labor union, customers, and society at large. So they have some kind of interest to know what the organization is doing. Therefore, accounting preferred as a language to communicate with others about their activities. Move to the next. In order to understand the accounting, we should have a clear idea about what is organization. We should have a clear idea about what is business. So we will see them first. So the organization in the sense that is a group of individuals who come together to pursue collective goals and objectives. So here the group of individuals in the sense this is an effort of more than two individuals. And here the term collective goals in the sense organization try to achieve multiple goals rather than depending on one goal. Sometimes organization try to achieve profit. There are some kind of organization try to achieve or the health of the people. For example, hospital, their goal is enhancing the health of the people. So moving to the business organization, this is a kind of organization, but it's particularly right to attain the profit. Okay, so they sell product or services in order to make profit. So a non-business organization, or we can say not-for-profit organization. So there are some examples, the charity, hospital, those exist meet various societal needs and does not have profit as a goal. So they like to achieve the goals of the society. So let's move to the type of business. So business can be categorized into proprietorship, partnership, and the companies. Let's see one by one. So the first one is proprietorship. So the proprietorship is a business owned by one person. Okay. So in this kind of business, one person can invest from his own and he can lend the money from the banks or other source, for example, lend the money from the banks and his friends and relatives and invest them together in a business. So in this kind of business, there are no separate legal entity, which means in this business, the owners and the business will be considered to be the same. So the next type is partnership. A partnership can be started by 1 to 20 partners and they can share the profit based on the proportionate to their capital invested. So in this partnership also, there are no separate legal entity. So here also, the business cannot be separated from their owners. The third category is companies. So in worldwide, it's known as corporations, but Sri Lanka, we are calling as company. So company is a business owned by one or more owners. So the owners are the shareholders of the company. So in the partnership, owners are partners, but in the company, owners are known as shareholders. So a shareholders own the share of the ownership of an organization. So shares are unit of ownership in a company. So a corporation shares can be rated privately or publicly. So the rated privately in the sense only few shareholders can own the shares of those companies. The publicly in the sense shares can be rated in the stock exchange of a country. For example, in Sri Lanka, public listed companies can sell their shares through the Colombo Stock Exchange to the entire population of the country. So this kind of business is known as publicly listed organization, publicly listed companies. So publicly listed companies in the sense a company that sells its shares publicly typically does so on a stock exchange. So private limited companies, a corporation that calls its shares privately, its shares are often held by only one or few shareholders. Move on to the next. So far you have a good idea about what is accounting and what is organization, business, and the type of business. Next, we will move to the gap. So, generally accepted accounting principles. So, the goal of accounting is to ensure the information provided to decision makers is useful. So, we already studied that the accounting provides the information to the users in order to make the economic decision. Therefore, the information provided by the organization should be appropriate to take the economic decision. So, valuable decision. So, to be useful, information must be relevant as well as faithful, represent a business economic act. Therefore, this requires ethics, beliefs that help us differentiate an organization whether it's doing right or wrong in the application of underlying accounting concept or principles. So these underlying accounting concept or principles are known as generally accepted accounting principles. Worldwide, international accounting standard committees provide the international accounting standard, which means international financial reporting standards to the world as a whole. However, there are some countries, they also publish their own choice of GAAP. For example, in Sri Lanka, Sri Lankan generally accepted accounting principle is known as Sri Lankan Financial Reporting Standards, prepared and published by Institute of Chartered Accountants in Sri Lanka.
Moving to the next, accounting concept. In accounting, there are different concepts. Based on that, accountants should prepare the accounts. The first concept is the entity concept. In accounting, we make a distinction between business and the owner. Especially in accounting, the business and its owners are rated as two separate entities. For instance, if an owner invests something to the business consider that one as a credit. So, which is called as the capital, and this liability should be repaid to the owner. Likewise, if the owner borrowed anything from the business, this is rated as the drawings. So this is a kind of assets. The owner need to settle that assets in the future. In a sole tradership, there are no legal separation between owner and the business. However, based on the accounting entity concept, the business and the owners are rated separately. So, the personal transaction of the owner are not recorded in the accounting books. For example, if an owner purchases a car for their personal use, it will not recorded in the books of accounts of a business. Moving to next concept, going concern concept. Accounting assumes that the business entity will continue to operate for a long time in the future unless there is good evidence to the contrary. The enterprises is viewed as a going concern that is as continuing its operations at least in the foreseeable future. Because of this assumption, the accountant charges depreciation on fixed assets in the basis of going concern. Next, we will move to money measurement concept. In accounting, only those business transactions are recorded which can be expressed in terms of money. If an event or the transaction which can be measured in the monetary terms, that will be only recorded in the books of accounting. Non-monetary transactions are not recorded in accounting. For example, the qualitative aspects of the business cannot be recorded in the books of accounting. As we have already discussed, Going concern is one of the accounting concept. In addition to the going concern, let's see accounting period concept. So accounting period concept in the sense accounts should be prepared for a specific period. Although the business is expected to operate for a possible future period, accountants should be prepared the financial statement for a specific period. Normally, companies prepare their financial statements for an year as well as quarter. Next one is cost concept. The cost concept assumes all the assets that is purchased within the organization should be measured in the historical cost. So the historical cost in the sense the price actually paid for acquiring the assets. So the market price of the assets will never measured under the cost concept. Dual aspect concept. Every transaction of the business has two effects. One is debit, other one is credit. For instance, the first one is cash sales rupees 10,000. As a result of this transaction, company received 10,000 cash from the customers. So this is an asset and it has a future value. Therefore, this is a debit side of the transaction. At the same time, company make a revenue of 10,000 through these sales. So this revenue should be paid to the owners of the organization. Therefore, this is the liability of the organization. So, this is the credit side. As a result of this concept, the accounting equation has been created. In the accounting equation, all the asset is equal to liability plus equity. So the organization can fund from the owner's equity plus any kind of liability. So these owner's equity and liability turned into the assets of the organization. Therefore, the asset of the organization is equal to liability and the equity. Let's see what is realization concept. As we have already discussed, accounting period concept, accountants should prepare the accounts for a particular period. Therefore, the recognition of the revenue will be questionable since when and when the accountant should recognize the revenue as well as cost relating to that revenue. So, the profit is earned when goods or services are provided or transferred to customers. Therefore, if an order placed to an organization that will not a time to recognize the revenue. Like that, it is not vital to realize the revenue when the customers pay for the goods. Instead of that, according to realization concept, revenue is recognized when sale is made. Sale is considered to be made at the point when the property's goods passes to the buyer and he becomes legally liable to pay. This implies the revenue is generally realized when goods are delivered or services are rendered. Next thing we will talk about matching concept. This concept is based on the accounting period concept. In reality, we match revenues and expenses during the accounting periods. Matching is the entire process of periodic earning management, often described as a process of matching expenses with revenues. For example, if an organization sells 10,000 of goods in a particular period, the organization should deduct the cost of these goods, that means the purchase price of that goods, in order to calculate the profit. So, the sales should be matched with the cost of that sales. Based on this matching concept, accrual accounting method has been developed. In the accrual accounting method, accountant assume that the cost and revenue should be recognized when it's realized rather than when it's received or paid. Let's see an example. Salary paid in 2012-13 relating to 2011-12 year period. So in this case, the actual cash paid on the next year of the salary. So, such salary is treated as expenditure for 2011-12 under the outstanding salaries account, not for in the paid year, that is 2012 and 13. So, since the employees worked in the 2011-12 and its influence on the profit of the 2011-12, it should be rated as the expenditure in 2011-12 period based on the matching concept. So far, we have discussed about accounting concept. In addition to accounting concept, conceptual framework for financial reporting also explain some principles of financial reporting or financial accounting. Let's see what is conceptual framework for financial reporting. International Accounting Standard Committee published the International Financial Reporting Standard. They also provide the conceptual framework for financial reporting in order to understand the financial reporting. In Sri Lanka, this is merely same under the Sri Lankan reporting standard. So first see what is the objective of financial reporting. As we have already studied, the objective of accounting or the financial reporting is to provide financial information that is useful to users in order to make the economic decision. This conceptual framework listed two kinds of fundamental qualitative characteristics of financial reporting. The first one is relevance and the faithful representation. The relevance in the sense information provided by the financial statement should be relevant if it is capable of making a difference to the decision made by users. Financial information is capable of making a difference in decision. It is had predicted value or confirmatory value. If the information is relevant to a decision, then only the financial informations will be quality. The second characteristic is faithful representation. Faithful representation in the sense business should provide the truthful information to the users. These faithful information mainly determine on the uncertainty level of the business. And if the organization provide the faithful information, which means the organization can be a neutral and free from error. Conceptual framework for financial reporting also provide enhancing qualitative characteristics. The first enhancing qualitative characteristics is comparability. Financial information used by various users in order to make the decision by comparing financial reports of different business. Therefore, the financial statements should be comparable. The second characteristic is verifiability. The verifiability in the sense the users of the financial statement should be able to find out the root cause of every figures shown in the financial reports. The third one is timeliness. Since the users refer the information provided by the organization on the financial reports for the economic decision making, it should be provided on time. Therefore, the accountants of the organization should ensure the timeliness of the information provided by them through the financial statements. The last characteristic is understandability. Generally, the financial information provided by business are used by various users over the world. Therefore, the business should ensure the understandability of the information provided by them. In this chapter, mainly we discuss about principles of financial accounting. In the next chapter, we will study about accounting equation and the financial statements. Thank you.